Today at InvestTalk, we look at a report about the major banks at risk of a bank run. Then we discuss if the recent bull run in markets can be sustained. And then we answer questions about Clean Harbor, NiSource, and more. And at the end, I look at how real estate commissions are evolving.
This is InvestTalk. Independent thinking, shared success.
Now, our main focus point has to do with a new report out of Florida Atlantic University. And they flagged 91 U.S. lenders, including JPMorgan and many others, at serious risk of a bank run. So you're talking about JPMorgan, Bank of New York Mellon, Citibank, Northern Trust, State Street, HSBC, as well as U.S. Bank, that all have 50% or more of their deposits that are uninsured, above that limit. Okay. And so the warning here is that, hey, they could be like Republic First Bank in Pennsylvania, who previously was on this list at 87, which had 51.5% of its deposits uninsured, and they recently collapsed. So the question is this serious, right? Is this something that you should really be worried about? Or is this a smaller university that is trying to make a name for themselves, trying to drum up headlines in order to scare the public? And is this being pushed by websites and social media in order to invoke the emotions? You know, think of 2008. And this is a perfect example of PTSD that people still have about 2008, and that the media, both traditional and social, prey on that psyche around, oh my God, we're going to have 2008 again. Things are going to crash and the world is going to go to hell in a handbasket. This is pervasive. I call this bear porn, right? It's all about, hey, this is the next crisis. The market's going to crash, etc. And I understand that, mainly because I understand the human psyche. But you have to go a bit deeper than just your feelings around 2008 and the financial crisis. And refocus on what's the reality, not the hyperbole. What is the reality of the situation? Who has the power to do something about it? And what is their incentives? What are their incentives and motivation around the outcome? And it's pretty simple. Those within government, mainly the Treasury and the Fed, also have PTSD. And they don't want that to happen again to them. So what are they doing? They're doing things like the BTFP program. Last spring, when we had the Silicon Valley Bank crisis. Similar to what they're kind of warning about, right? What did they do? It was the Bank Term Funding Program. That's what BTFP stands for. And it allowed them to paper over the losses, at least near term, keep themselves insolvent. It's not insolvent. Keep themselves solvent and get through the crisis. And so you need to learn from that situation and apply that and say, what's more likely? That if one of these banks goes through another major issue, like Silicon Valley Bank, is it more likely that the Fed and Treasury are going to step in and prevent contagion and ring fence the problem and keep things together and moving forward? Or are they going to pull a Lehman and they're going to let it go under and create all types of counterparty risk that could reverberate through the financial system? Which one is it? I'll tell you which one I think it is. It's not the latter. It's not the latter. Now, does this impact your investing in some of these smaller banks? Yeah, I think that's true, right? Because it doesn't mean those stocks can't go down. Doesn't mean many of them are poor risk versus reward, especially those medium and small banks, because those can go under, or the equity can be wiped out without really an issue. You know, is the Fed going to allow JPMorgan's equity to be wiped out? Probably not, right? That creates contagion. So you have to be very cognizant of what the reality of the situation is. And so don't allow these type of hyperbolic headlines to impact you, to impact your process of finding good companies, good investments, with the notion or the thought that, because of these serious issues with these banks, it's going to take down the entire economy. Okay? When you start thinking like that, then you take your eye off the ball and you get sidetracked. And so my job here is to keep you focused on what really matters. And guess what? These headlines, they don't really matter. Now let's take a quick look at the market today. It was another green day overall, and the market just kind of continues to float higher. A very interesting day in regards to the type of stocks that did well. Small cap growth actually did the best. So that was pretty interesting. Among the active names, we didn't really have any big movers. Intel up 2%, Nvidia up 1%. Any big? Macy's was down 13%. That was the big loser on the day. Keysight Technologies up about 14%. That was the big winner on the day. And we are in this period where, the economic growth continues to be decent. Bank credit growth is rising at about 3%, 2.8% year over year. And that's fine. That's a level that is commensurate with solid economic growth. And, it's hard to get a major drop in the markets when earnings expectations continue to head higher. And all of the main drivers of future economic growth, mainly bank lending and government spending, those continue to point upward. Now, the Atlanta Fed GDP Now estimate did come down from close to 3%. Now we're down to 2% on the quarter. But once again, that's 2% with inflation continuing to slow. That's not a bad place to be. Maybe a choppier place to be, but it's not a bad place to be when it comes to asset prices in general. Now, seasonally, we are in a seasonally weak part of the market. Weak time of year. August and September tend to be the worst performing months, but that's in aggregate. You've had plenty of great Augusts and Septembers. So it's not like it's guaranteed to be bad in August and September. It just tends to be a bit more volatile. That's it. Now, a lot of people look at that and they try to get cute. And they say, I should raise a bunch of cash. We're in that time of year, etc. And frankly, that's a fool's errand, right? Trying to time that, especially when global liquidity is generally positive. The credit markets are fine. The dollar's rolling over. That's really the main big story right now. Dollar is weakening, not just against the yen, but also the euro. And then you also have gold remaining robust, okay? And breaking out near all-time highs. Down a little bit today, but still in that strong uptrend. So overall, it's a constructive situation going into the election season, which, that could bring some more fireworks, certainly. But that's it. That's where we're at. So I wouldn't get too cautious on the market, at least for now. Most likely, we have a generally positive market through year end.
Hey, this is Andrew from Atlanta. I was calling about Clean Harbors Incorporated, CLH. I held it for a while. It's done very well for me, and I'm probably going to trim it just a little bit, but was curious. how it's looking currently and perhaps where it's going. I appreciate your advice, and I'll listen to the show. Thanks.
All right, looking at Clean Harbors Inc. This is on a solid uptrend, relative strength very high, 91. And for everyone else out there, what they do is they provide collection, transportation, treatment, disposal, and site decontamination of hazardous and non-hazardous materials. So it's a very consistent business. They have a very strong balance sheet, only a couple $2 billion in debt on a $13 billion market cap. Free cash flow is about $240 million, but it is on the expensive side. Okay, 33 times earnings, but return equity, 17%. Very, very consistent performer, right? Free cash flow is $239 million. Not an amazing free cash flow yield, but a consistent grower of that free cash flow, which I like. And what are they doing with that cash flow? They are buying back shares. They bought back over 10% of their shares over the last decade, which I really like. No dividend, but once again, it's a good business. Would I trim it? It's on the expensive side, but it's not egregious. And there's nothing technical that's telling me, oh, this needs to be sold right now. So I would just continue to hold it, maybe have a tight stop. On the chart, it's basically held the 50-day moving average ever since this move started back at the end of last year. And so as long as it's holding that, I would just hold it. If it breaks that 50-day, then you start to wonder, okay, are the technicals starting to weaken? But right now, I think it's fine. I would hold on to Clean Harbors, CLH. Now let's keep things pushing ahead and play another listener question that came in earlier on 888-99 chart.
Hey, Luke or Justin. Nick from New York. Just giving a call out to you. I called last week regarding a question with 401s, 457s, and the limited range of options that are available through my employer. So just as a follow-up, I gave a call to the holder of the accounts, and I tried to see if there was a possibility or any rules about rolling over, to which they said that I really can only roll over an account outside of the agency if I retire or am terminated. So I just wanted to kind of, as a follow-up, ask you, what else can I do? I'm considering not making any more deposits into that account and perhaps opening up a new account. And I'm sure we could talk more specifically about my situation one-on-one, but I just wanted to hear a little bit more about your new 401k and 457 investing that's sponsored by you guys. Thank you for your show. Looking forward to hearing it on the podcast.
Great question. So usually if you're contributing to your retirement plan at work, then you have to keep it there until you're 59 and a half. Then you can do what is called an in-service rollover into an IRA. And almost everybody should do that because then it opens you up to a lot more investment options. And typically you have costs associated with actually that 401k going. And many times the employees are burdened with that cost. Every plan is different, but be aware of that. So that's ideal. If you can roll it into an IRA, whether that is with an advisor like us or just doing it on your own at a big broker like, an E-Trade, a Fidelity, a Schwab, etc. So that's the best option. Now, the second best option is to, have somebody like us manage it. And we can do that now through a new piece of software we've deployed. Allows us to see all the investment options, rank them, analyze them, target particular risk levels based on the risk questionnaire that we give our clients, and then from there also build out a full financial plan to see how that would apply to the full situation. So I think that's it's groundbreaking. This is something this is like the holy grail we've been trying to do for my entire investment career. Saying, okay, how can we help these people who have 401ks, 457s, 403bs, even 529s, where they have limited options, but they also don't have the ability to analyze these funds and understand which ones they should be in, what mix they should be in based on their risk tolerance level, based on the market trends, et cetera. And now we're able to do that. So that's really cool. So that's a little bit more about that particular strategy. But hopefully at 59 and a half, you eventually roll that into an IRA.
Hi there, Duncan from New York. Thank you for all that you do. Calling on stock ticker StoneCo class, STNE. It's a small cap financial stock. Reason why I'm interested in this is because, well, it seems pretty decent for a financial stock. When I look under the return on equity, about 12%, of return on assets is about 3%. I just want a financial, or I guess an analysis on this. And if you can answer this question too, infidelity, when I'm looking under debt, because you guys talk about like whether some company has too much debt, there's like a little line that says long-term debt / equity, TTM. It says 26%. Now, if I was looking on Fidelity in the future for other stocks, like, is this too much debt? Is it low debt? Like, what's the type of percentage that I'd be looking for if someone has, like, long-term debt or total debt assets? Thank you very much, and have a good day.
All right, looking at StoneCo Limited, and this is a Brazilian company, and it provides financial technology solutions for merchants and integrated partners. Now, when it comes to what you're looking at debt to equity ratios, and it's not a great metric just because equity can kind of be skewed based on accounting metrics, et cetera. Now, I tend to look at like total debt to its assets. Even that's not as good as something like total debt compared to cash flow times interest earned, for example. So what's the interest it's paying on that debt, and then how much is it earning in order to cover that? You want that typically 2 to 3 or higher. This is at 1. Okay, so that's one issue there. And this doesn't have a ton of debt compared to its size, I will say that. But it's a Brazilian company, and that's an issue. And its free cash flow is decidedly negative. It tends to be hard to fake that. Okay, so overall, the trends in the stock are fairly neutral to poor. Our relative strength is 33, so it's the bottom third of performers over the past year. That's not good. And I just think this is more of a technology company really than a financial company. It might say it's in the finance world, payment processors, et cetera. But it's more, once again, in technology. So I don't like it. I just don't think there's enough to like about it. The fact that it's a Brazilian company, that there's issues with governance as well as government in Brazil, and then the charts just don't line up either. So I'm passing on this one. STNE. Thanks for the call. Now, help me telling your friends about the InvestTalk audio podcast being available in video form, where I share my charts and data for the stocks that I'm looking at. And we get questions submitted in the comment section over there, so I encourage you to check that out. And Priya Lori 9485 says, do y'all have an opinion on dual direction funds? I love this question because I had never heard of a dual direction fund. I'm like, what is this? I've never heard this. Okay. It's a dual direction buffered index strategy. It takes advantage of market's growth up to a predetermined cap rate and enjoys a certain level of buffer protection against market losses. This is just a structured product. And they're slapping a new name on it. I can just imagine what they were doing in the marketing boardrooms. What are we going to call it? How do we get people to buy more and get interested in it? Let's call it a dual direction. It goes both ways, but you're capped on the upside, and I just can see all of these marketing jargon that they're throwing around and trying to get people to buy these things that, frankly, are very high fee and don't really do what you want to do. It's kind of like an annuity, really. With a new name. They're a little simpler. There's usually a defined end date, etc. But the fees within them tend to be very high. So this is just a marketing gimmick. And it makes me say, know what you own. Don't just go based on the title of things. I see this all the time, whether it's an ETF, whether it's a mutual fund, whether it is a structured product like this. They title it something, and then the buyer thinks that's exactly what they're getting. And the devil is in the details. And oftentimes it's very different than, and doesn't really pencil out. Okay. So these things are just marketing gimmicks and don't really have a place in anyone's portfolio. Now let's take a look at the best performing stocks of all time. Of all time. And you're talking about, companies that have returned millions of percent. And this is a database compiled by Arizona State University professor looking at data going back to 1925. So nearly 100 years. And the best performer of all time, no, it's not Berkshire Hathaway. It is Altria, formerly Philip Morris. 265 million percent. Now, what's interesting here is that in second place is a company that's not very exciting. It's not even that big right now. And it's at 39%. So the gulf between Altria and the next on that list is Vulcan Materials is 39 million. So that's over a 200 million compounded return difference. Just shows you how profitable cigarettes were, especially for a long time. Now, Altria, it's been a lagger more within the industry for the last 20 years. But, it just shows that, you go back long enough, you have certain level of consistency with your business and profitability, you can have incredible returns. Now, what are some of the other biggest names on this list? Kansas City Southern is third, General Dynamics fourth, Boeing, IBM, Eaton, S&P Global, Coke, Pepsi, Abbott, Universal Corp, Deere, Hershey, etc. So those are kind of the top performers. And once again, Vulcan Materials, that's an Alabama gravel company. Not an exciting business. And that's what you can see with that list. Most of those are not in glamorous industries. It's about longevity, and steadier wins the race. Now, they looked at 30,000 U.S. stocks in this database. The median lifespan of a public company, 6.8 years. Only 31 companies are present across the entire 98-year span. Went through the end of last year. Only 31 of the 30,000. Think about that. Now, of the top performers on this list, they all go back before 1951, except for Northrop Grumman. That was in 1951 when they went public. And the difference between the mean and the median is huge. So the mean is the average of the database. And the mean is 22,000%. 22,840%. But the median outcome is actually a loss of 7.4%. Why? Because over half of all common stocks in this database incinerated money. They lost money. They issued shares to keep a bad business going. Think about that. That means half of the companies in the market are simply bad investments, negative investments, not underperformers. You're talking about negative. Over half. Now, you might say, well, there's a lot of those names that haven't been around long enough, okay? Because, there's some big winners as of late. And over the last 20 years, the annualized return over a 20-year period, and you'd be surprised, maybe not surprised, that NVIDIA is actually tops the list, 33% annualized since 99. Second on the list, though, a name that was bought out in 1998, Plenum Publishing. They make science journals. Once again, fairly boring. Netflix at 32%, Amazon 31%, Axon Enterprises 31%, Sperry Corp 28%. And a lot of these are also still relatively boring names. Pool Corp, the world's largest swimming pool distributor, on that list as well. And even Time Warner, after bad AOL merger and being bought out eventually by AT&T, it's still on the list of top annualized performers. So it just goes to show you It's not about chasing the sexy names. The vast majority of these names have two things in common: great businesses and longevity. And one of the reasons there's not more tech companies on this list is because technology companies, they tend to rise fast and fall fast. Because once they lose their edge, someone else is gaining that market share. Just think of Apple and BlackBerry, for example. So I wanted to highlight that because it's very important to understand the difference and what to look for when trying to find those huge winners. And you're not going to find them on Wall Street Bets on Reddit. Now, this is InvestTalk. Let's play another caller question. You know the number. It's 888-99-CHART.
Hey, Justin and Luke. John here from Central Florida. I know you guys have discussed this topic many times in the past, but at this point where I am, I'm leaning strongly towards rolling my traditional 401k to a Roth 401k through my employer. They made this option available a few years ago, and I've just been kind of tossing it around for a while. And now I feel like it's the time. I feel confident about it's the right move for me. But I personally do not anticipate taxes to be any lower than they are now within probably the next century. So what sort of fees and at what magnitude should I expect to pay when I make this transfer? And will they all be at the time of transfer, or how does that work as well? Just wanted to get your professional opinion on this matter. Thank you, and I look forward to hearing your answer.
Well, there's no fees to convert typically an IRA to a Roth IRA or 401k to a Roth 401k. Typically not fees to do that. Maybe the provider might charge that, but Schwab doesn't charge that, at least for us when we're doing those Roth conversions for our clients. But from a tax perspective, that's a CPA question. I don't know your tax rate, and I don't know your income, how much you're doing, what's going to put you in a different tax bracket. And this actually, I would not do this until you build a financial plan. This is something we do for clients. It's part of our service, is building out a full financial plan and planning Roth conversions. This is extremely important because this is one of the lowest hanging fruit anybody can do, is plan your Roth conversion strategy. Because when you're converting from a traditional IRA or Roth or traditional IRA or 401k to a Roth 401k or Roth IRA, it's all about your tax rate today upon that conversion versus what is likely to be in the future. For the vast majority of people, the best time to do it will be the year they retire. They're fully retired, meaning no work income that year, and the time that they take Social Security. Because you're going to be in a very, very low tax bracket, and you can fill that all the way up to maybe 12%, maybe 20%, depends on how much money you have, tax situation, whether you live in a taxable state, et cetera, what your longer term goals are. And that's a sweet spot for most people to do those Roth conversions. So that when they hit RMD at 73, 74, they aren't taking out vast sums, pushing them into a higher tax bracket. It's controlling that tax rate. And I like that you're thinking about it, but there's no chance that anybody, including myself, can give you that advice simply based on a phone call like this. This takes a financial plan. These are things where, sorry, your robo-advisor is not going to help. You need an advisor. Ideally, a financial advisor that can have the tools. We have the tools. We use Orion Planning. We use Orion for our client reporting, as well as our financial planning software, and it has these great tools, among many others. And so when you call and ask about that, I can't give you an answer. If you're a client, we'd run you through this, and we plan that out as we do with most of our clients. So certainly great to be thinking about, but not something that anybody can answer like that. It takes a process. Thanks for the call. Now, let's see if we can fit in one more question now.
I would like your opinion on ticker symbol NI in the utility space. I'm hoping to add this high dividend player to my portfolio in a Roth. And one of the reasons I wanted to add it was because I don't have any utilities currently. And I'm just wondering, do I need every sector to be represented in a long-term portfolio? Thank you so much for your guidance.
All right, looking at NiSource, the nation's largest natural gas distribution companies in Indiana, Kentucky, Maryland, Ohio, Pennsylvania, and Virginia. Now, do you need every sector? No, you don't need it. Historically, utilities are the lowest returning sector across all the sectors long term. So typically you want a low exposure to utilities, but it doesn't mean you want no exposure, because there are great utility companies out there, good solid performers. We have them in almost all of our strategies, but they're low single digits in exposure. So if you have none, NiSource, it's a good one. You said high dividend payer, 3.3%. Honestly, that's not high within the industry, but it's a good performer. It's fine. The relative strength is 83, which is high for utilities. And obviously the fact that rates have dropped on the long end of the curve have certainly helped utilities as of late. So, is it the perfect time for entry? Probably not. But, this is a solid one to add if you want to get some exposure, which I think is probably a good idea. Now, earlier this year, the National Association of Realtors reached a settlement over commission, basically collusion. And the 1.5 million members will be subject to some new rules around this settlement. Now, the big question is, how is this changing the home transaction process and commission structure? Now, typically it was, cost 5 to 6% of the sale price to sell your home, and you split that with the buying and the listing agent. But that's all changing now. First off, the MLS will no longer show how much the buyer's agent is going to get. And the buyer will be required to sign an agreement specific to how much the agent will be paid before they start touring homes with the agent. So this means that buyers now have to negotiate with their agents. And that's still in the kind of discovery phase of what that typically looks like. Now, is this going to bring home prices down? Oh, maybe. You can sell your home for a little bit less and pay less commissions, and you're going to net out the same. Well, you could take a little less, right? Or maybe they just pocket the difference, especially in a competitive market with tight supply like we still remain in today for most markets. Now, if you've sold a home over the past decade, you actually may be entitled to some of this payout. So you might want to check into that. The question is, if you're buying a home, do you need a real estate agent? Well, last year, 90% of buyers still did use one. But it depends on how much time you have to shop around, do a home search, and the ability to negotiate. A lot of buyers are now negotiating a flat price, an hourly rate, or a specific, suite of services, right? Cost per home tour, etc. Others are still kind of sticking with the standard 2%. Typically, being a buyer's agent is a bit easier than being a listing agent. You have to do a whole lot, right? Listing agent, you prepare the home, and there's a lot more marketing involved, as opposed to a buyer's agent. Yeah, you have to maybe show them a lot of homes, and some clients are easy, some clients are really hard, right? Because they never actually put in an offer, and they just keep looking, and their expectations are too high based on their price, etc. So it kind of varies, but in general, the listing agent is more justly compensated. You can also hire a lawyer, right, to look over the contracts, and you do the negotiation and the search, etc. And I think that could be more common. Now, who's going to pay the agent? It doesn't have to always just be you. You can actually negotiate in the deal that the buyer, based on the money that they're getting from the sale, is going to compensate the buyer's agent. Sorry, the seller is going to compensate the buyer's agent. Now, what if you agree to a certain amount, let's say $10,000, and You find a home and they're offering to pay the buyer $20,000. Well, you can negotiate. You don't have to pay them $10,000 and lower the price by $10,000. Things like that. So it's going to get a lot more flexible, which makes it a bit more complex. Now, I do think there's still value in buyer's agents. It's just a matter of what is that worth? Is it worth 2% of the value of the home? Well, it probably depends on what market you're talking about. On a couple $1 million home, is $40,000 worth it? Maybe not. Now, if the home is, say, $300,000, well, $6,000 to go through the process and find you that home might be worth it. So I think it's going to vary dramatically, and things are still in flux. But know that these rules are the new way of doing business, and you have to see what works for you, because there's no hard and fast rule quite yet. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And I hope you've heard that InvestTalk podcast is available in video form over on our YouTube channel. So head over there and subscribe. Independent thinking, shared success. This is InvestTalk. Good night.